While we normally meet with legislators and policymakers during Al Sear Day on the Hill, COVID forced us to alter that as well. Instead of meeting in person at the State House, we will be holding a series of virtual meetings with key leaders. The first one was held January 15th with Indiana Insurance Commissioner Stephen Robertson. It was a very thought-provoking session. For those who couldn't attend, here are some highlights.
The Indiana Department has continued to operate, I think, as efficiently as possible during this pandemic. We've been open every day, many of our people working at home, and that's turned out to be better than what one would imagine. The first question is, what should insurance agents know about the recently passed cybersecurity law and obligations they have under the law? The Office of the Attorney General Consumer Protection Unit filed a proposed rule in Indiana that seemed to conflict and overlap with the data security law that was enacted in the last session under HEA 1372, which is the Department of Insurance's jurisdiction. The governor's office disapproved the proposed rule of the AG in 2020. The Attorney General's office filed a revised rule, but the department still had concerns with overlapping jurisdictions. The governor's office disapproved the proposed rule on January 8th, 2021. The department is now able to continue planning and rulemaking process for implementation of requirements for data security of insurance entities in Indiana. We will be welcoming comments and suggestions from stakeholders, including NAFIA, so please let us know if you have any special comments for us to consider while we're implementing the required process in Indiana. I'm being asked my thoughts on the NAIC stability and annuity transaction model regulation. Arizona, New York, Michigan, Arkansas, and Iowa have adopted this common sense consumer protection policy for guaranteed life income requirement annuities. It's kind of a complicated question, but I think it introduces an additional level of transparency to the process. The NAIC, in collaboration with many industry and consumer groups, has developed an approach that appears will serve the public well. There were some complicated proposals around requirements that the agents be aware of every possible investment vehicle, be it CD, interest rates, security returns, other companies, and a variety of investments. The approach the NAIC has developed is one that can be followed by the agents, is not overly burdensome on the industry, and does meet the needs of the consumer. However, we're going to continue to review it and to see if there are additional protections or different tweaks that we need to make. As it seems options for Hoosiers in long-term care partnership program have been going down in recent years with companies leaving the program. What can Indiana do to encourage companies to participate in this important program and provide options to Indiana consumer? The department has started rulemaking to reduce the dollar for dollar inflation factor percentage from 5 to 3%. Hopefully that incentivizes companies to file new products and increase LTC products. If Indiana were to move from the Indiana Partnership to the Deficit Reduction Act, the main concern is making sure existing policies in Indiana are grandfathered under any changes to ensure those existing policies would not lose their total asset protection. And I think that we're well over 33,000 policyholders. And as you can tell, if something was drastic and they lost that asset protection, there would be a large hue and outcry. And we do not want that to happen. Whether we move to the Deficit Reduction Act language is entirely up to the legislature. Our concern, as I said, is to protect those existing policyholders. If the legislature deems it appropriate, obviously they have the ability to do so, and we will comply with it, obviously, and implement what needs to be done. I would like to go into a couple things. One is to make you aware of the Special Executive Committee on Race and Insurance that was formed in July 2020. There are 5 work streams. These areas are serious and they need to be addressed. There's going to be recommendations. We have been obviously participating in these. What exactly is going to come out, I don't know yet. There are some drafts of recommendations that are not public. I can tell you that while I agree that this needs to be reviewed and looked at, and it's a very serious issue, I have tried to remind our colleagues, my colleagues, to stay in our lane, insurance lane, that we cannot try to reach out and address issues for real estate agents and different lines that we are not the group. Each group has to look at their own selves. And so let's be realistic on what we can do and what our authority is, and not try to go into areas that are outside our lane. I think for the most part, that's going to happen. But as you can imagine, with 50 states and 6 other jurisdictions, there's 56 people, and sometimes the recommendations and thoughts can vary greatly. The second we're on is the Long-Term Care Insurance Task Force. And as most of you know, they're trying to develop a consistent national approach for reviewing LTC rates that result in actuarially appropriate increases being granted by the states in a timely manner and eliminates cross-state rate subsidization. Sounds simple, but very complex. One, the cross-rate subsidization issue is something that I have discussed with my colleagues and told them that I'm not sure this has actually occurred. One has to remember that insurance companies, for the most part, on long-term care, when they introduced a product, the premium was the same no matter where you live. Now, what we found is long-term care costs vary greatly. Costs in Connecticut are much more than what the costs are in Texas. The question I've always asked is, when did this cross-state rate subsidization occur? At the very beginning, or now, or when? And there are proponents that believe that we should grant rate increases, whatever the companies want. I am not one of those proponents, as most of you know. I do have a background in long-term care insurance. We do an in-depth review of every filing. There are many things we look at. I think we do one of the most extensive and the best job of reviewing rate requests in the United States. And some rough projections are that in the 10 years that I've been doing this, we've saved consumers in long-term care about $250 million. That money stayed in this state and they could spend it the way they wanted to. We just got our new committee assignment, and I'm a member of the Property and Casualty Insurance C Committee. They have denied me membership on the Financial Conditions E Committee. That may be due to the fact that I have a tendency to raise my voice and objection on things that I don't think are correct, and have been reasonably successful in defeating them. And so that one's countergrain to you, as you can imagine, to the Get Along gang at the NAIC. So they try to eliminate dissenting voices. I will continue to be a dissenting voice on issues out of a committee, whether I'm on it or not. Our points will be made. So we're going to be active at the NAIC, but I think also being active at the NAIC means that you have to have gumption to be able to stand up and state things that you think are right or things that are wrong. But I want to assure you that this department will continue to be active and making comments when appropriate, defending the industry, defending consumers, and we will always try to do the right thing and seek input for the industry and consumers when appropriate.
Don't miss our next virtual day on the Hill, February 5th at 11 a.m., when we will be talking with Chair of the Senate Insurance and Financial Institutions Committee, Senator Andy Zay. Go to nafaindiana.org to register.